What is going on, ladies and gentlemen? Today we are going to be talking about the long butterfly. Now, the long butterfly is a really interesting strategy. It requires very little capital, but it's very precise because essentially when you're doing a long butterfly, you're saying that a stock is going to go to a certain price and it's going to end at that certain price. So say we bought a long butterfly on TLT at $144. That's our price we thought it was going to. In order to get our max profit, it would have to end exactly at $144, and it couldn't end anywhere outside of our wings. But I'll give you a visual example in Robinhood because I feel like Robinhood has the best visual example. Of course, Robinhood is probably the best thing for beginner options traders. So if you're just getting into options trading, be sure to check out Robinhood. So I'm going to do it on a stock that doesn't really have too much of a spread, so we'll just do it on this SPY. So there are two types of long butterflies you can do. You can do a long call butterfly, and you can do a long put butterfly. There's also short butterflies. You can do a short call butterfly and a short put butterfly, but we're just going to be talking about long butterflies right now, buying a butterfly. So on a long call, if we thought that SPY was going to end at 332 on February 7th, we would sell the 332 contract, and then we would buy our wings. We could buy the 332.5 and the 331, or we could buy the 330 and the 333 and make the wings a little wider. Now you might see the total cost here and see that it's 122, but here on Robinhood we have to customize the order because on a butterfly you're going to sell two of the middle contracts and you're going to buy one of each of the outside contracts. So we'd have to update this order to sell two 332 contracts, and this would be a $56 contract, and it's just because the wings are so wide. We can go back in here and it should only be like $10. Oh yeah, see, $21. That's still pretty decent. But you can do this on any strike price. That's the best part. A lot of people use this strategy by buying one in the money call, selling the at the money one, and then buying one more out of the money. And that's how a lot of people set it up. But if you don't think it's just going to sit here at $329, you're going to want to raise the strike price you sold up a few dollars. So maybe that's why you would sell two of the 332s and then buy the ones around it, because you think that the SPY is going to go up to 332. You don't think it's going to stay here at 329. But let's set up another one of these because I want you guys to understand what the max risk is and what your maximum gain is. All right, so we're going to set up this SPY butterfly. We're selling two of the 331s, we're buying one of the 332s, and we're buying one of the 330s. So this is saying by February 7th, the SPY is going to be at exactly 331, and we're going to get $100 if it does end at 331. And our total cost is $10, as you can see right here. So that's 1,000% play, but every cent that you are away from this 331, that's how much money you're gonna lose from the $100. And you have to factor in your break even. Your total cost was $10, so you have to minus $10 from the 332. So if you were at 331.10, you would only make $80 because you would have to minus your break even, and you would be 10 cents away from 331, so you have to minus that from your maximum gain, which is the spread between these two strike prices. I hope that makes sense. We'll do one on the put side as well, so you guys can get a little bit of a better visualization of that. So we can do the same thing on the put side. It's the exact same thing, but except we're saying that the stock's going to go down. So say we think the SPY is going to go down a lot. Say we think it's going to go down to this 326 right here. That's pretty far away from the money, but let's do it anyway. We sell the 326, buy the 327, buy the 325, update the order, so we're selling two of the 326s instead of one, and now we have a total cost of $4 instead of $10. So now we have a $100 max gain at 326, but our total cost is only $4, so that changes our break even. So that means you minus 4 cents from 327 and add 4 cents at 325. That's 325.04, 326.96, so you're able to make $96 on this contract. So if it ends at exactly 326, you'll make $96, but like I said in the calls, it's the exact same thing. Every cent it goes up above 326 or below 326, that's going to slowly lower your premium, your $96 potential you have here. So if SPY ended at 327.5 on February 7th, you would lose your $4, and that's it. This is your risk right here, this $4. So that's not that bad, actually. This is actually a really good play, in my opinion. But none of this is a recommendation. Option trading extremely risky. Those most are all your financial investment. Please consult with a financial advisor. They're not a recommendation. Educational purposes only. Thank you. And if it ended at 324 or lower, then you would lose your $4 and you would just lose on the play. Nothing would happen. This is your risk right here, this $4. So if you think SPY is going to end exactly at 326 on February 7th, this is a really good butterfly for you to play. But I hope that makes sense. I'll be making another video on shorting butterflies, and then I'll make a full video just about butterflies in general. So you'll have a bunch of different videos on butterflies on this channel, so be sure to check them out. Be sure to subscribe to the channel. If you have any questions, leave them in the comments below. Be sure to hit the like button. Be sure to check us out live. We're live Monday through Friday, market open to market close. And I'll see you guys in the next video.